Next question, explain Miller-Orr model of cash management. That is a question. So let us have understanding of one more cash management theory, that is called MO model, Miller-Orr model. Let us have understanding of this cash management theory. You do not have to write anything. First of all, let me explain you. The very first thing that the Miller-Orr model has said that we do not assume that expense of the company is evenly spread throughout the year. That is the first assumption that the first thing that they have said, that we do not make an assumption that the amount that we are going to spend is evenly spread throughout the year. Miller-Orr model says that, don't write anything, let me explain you. Expenses of the company is unevenly spread throughout the year. Third, dear students, said this model has given cash balance limits. They have provided three limits: upper limit, return point, and a lower limit. They have provided three types of cash balance limits. For example, just for understanding purpose, the example cash balance limits are 5 lakhs, 7 lakhs, and let us say that this is 10 lakhs. Miller-Orr model has given formulas for calculation of these limits. However, say we are not supposed to have understanding of them in our curriculum. That is the reason say we do not have any numericals with respect to the Miller-Orr model. The formula that say they have provided is something like this. As per the Miller-Orr model, we are required to find upper level as 3z plus lower level. Return point is z plus lower level. As far as the lower level is concerned, that is required to be decided subjectively by the company on its own as per the requirement of the business, and z is calculated as 0.75 into variance into cost per transfer divided by daily rate of interest, and the variance is also of the daily cash balance whole raised to 1 by 3. This is a simple formula that's they are given. I repeat that, as per the Miller-Orr model, the company is required to determine three types of cash balance limit. One is given a name as upper limit, another is given as a return point, and the last is given as there is a lower limit. How these so the limits will be working, how does it function, that I'm going to discuss slightly later on. But for the time being, they have provided these three types of limits. These limits are calculated by using certain formulas like this. However, we are not supposed to have say remember these formulas. Why? Because say they are not uh, included in our curriculum. This is upper limit, this is return point, and this is lower limit. Okay. So let us say that say we are having say these three limits, and based on that say how the theory works, that is what say I am discussing with you. In order to give explanation, say take help of a diagram. In the diagram on x-axis I am taking say the time period, that is independent factor, and on y-axis I am taking say the cash balance. There are three types of limits as I told you. This is UL upper limit. This is RP, that is return point, and this is LL, that is lower limit. How to determine? For that so the formulas are there, but we are not supposed to do any numericals. This is the time 0. So the point at which you start applying this theory, you have to keep any cash balance which is in between lower limit and upper limit. Keeping any cash balance in between both of them, you have to start applying the theory. For example, say you keep the cash balance equal to the return point, that is in our example an amount of 7 lakhs, and you apply this cash management theory. Then the theory says that, listen carefully, Miller-Orr model says that on daily basis, the cash balance is going to have a variation like this. At any point of time, so when the cash balance increases to UL, that is upper limit, at any point of time when the cash balance increases to UL, that is upper limit, then in that case, we are required to make an investment in liquid securities. We are required to make investment in liquid securities. Such amount will be invested in the liquid securities so that the balance reduces from upper limit to the return point. This theory says that say when the balance increases to the UL upper limit, it means that so the cash balance is substantially more than required. So immediately steps should be taken to reduce the cash balance. So cash balance will reduce from upper limit to the return point. Again, the cash balance will have some variation like this. Now it may happen that the balance reduces to the lower limit. Then in that case, whatever the liquid securities investment that you have made, that you have to redeem. That you have to redeem in such a way so that the balance increases from lower limit say to the return point. You have to enter into such transaction so that so the balance increases from lower limit to the return point. You have to check, do you have the liquid securities balance? Yes, redeem it. If no, then in that case you will make the arrangement of the funds by some other source of finance to bring the balance to the return point. Again, the balance will have a variation like this. So what you have to do, listen carefully. If the balance increases, bring it down. Increases to the upper limit, then bring it down by making investment of the excess funds in the return point. I'm sorry, by making investment of the excess funds in the liquid securities. How much amount should be invested? It is the difference between upper limit and the return point. And if at all the balance reduces to the lower limit, then in that case, one, either you will redeem the investment, or second, say you will make arrangement of the funds by some other source of finance if at all there is no liquid securities investment, and with that say you will bring the balance say to the return point once again. Last, if at all the balance is in between these two limits, if it is in between these two limits, then in that case no adjustment will be made. Neither you are required to make any investment nor you are required to redeem any investment. That is the way the theory has a given explanation. Please write an answer. First point. As per this theory, a company is required to determine three types of cash balance limits. A. UL in bracket write down upper limit. B. RP in bracket write down return point. C. LL in bracket write down lower limit. Second point, this theory does not assume that annual expenses evenly spread throughout the year. Full stop. As per this theory, amount required is unevenly spread. Third point, keeping a cash balance in between LL in bracket write down lower limit and UL upper limit, comma, the company will start implementing the theory. Full stop. After that, transaction can be entered upon as under. So friends, in that case, say I prepare a small table like this: cash balance and a transaction. In the cash balance column, I'm writing increase to UL, that is upper limit. So the transaction is invest an amount in liquid securities so that balance reduces to RP return point. Cash balance reduces to LL redeem liquid securities or arrange funds by some other way so that balance increases to return point. Again in the cash, that is balance column, write down is in between LL lower limit and UL upper limit. So if at all the balance is in between both of them, no transaction, full stop. Neither investment nor redemption, full stop. Please draw this diagram.